Buy index funds, buy index funds, buy index funds. You might hear that a lot, and you may question, well, which one am I supposed to buy? And if you're looking at something like the S&P 500, you may have heard of SPY, VOO, and SPLG. And they all track the S&P 500, but there are some key differences that can matter depending on your situation. So let's break it down. SPY launched in 1993. It's the most liquid, meaning if you're trading the shares themselves or if you're trading something like options, that helps being liquid. You're able to get in and out quickly. But it also has the highest expense ratio of the three that I just mentioned. So 0.09%, which is extremely low. But if you're holding on to, let's say, hundreds of thousands of dollars per year, any 0.01% change in expense ratio can add up over time. VOO, you've probably heard of this one. This is the Vanguard version that covers the S&P 500. And same exposure, it just has a lower fee. So currently at 0.03% expense ratio. So SPY is about 3 times as expensive in terms of expense ratio. So perfect for long-term investors who are focused on minimizing their costs. And then lastly, you have SPLG, which is from State Street. Also has a 0.02% expense ratio, so even better than VOO, but you have less liquidity because not as many people own this. One nice thing about if you own SPLG, it's a lot easier to do option strategies if you have less capital. So if you have a lot of capital, SPY still the best when it comes to option strategies. Less capital, you can sell a put for less capital. You could sell covered calls on one half of your position instead of only being able to sell one call, and then that's all of your SPY shares. So that's also interesting. So in short, SPY is basically for active traders. VOO is for long-term investors. And then SPLG is more if you want lowest cost or if you want to use less capital for options. If you did enjoy this video, make sure to follow for more investing tips in the future.